Let's say we're trading this pink cycle. Here is a trough of the pink cycle, and here is a peak of the pink cycle. And what's happening in price, however, is a trough in price at the trough, and then there's a peak over here, and there's no peak in the pink cycle there. There's in fact a peak of the green cycle. And where the peak of the pink cycle occurs, there's in fact a trough in price movement. Many people find that very confusing, and for many people, it's a reason why they reject Hurst cyclic theory, and they don't pursue it, and that is a great loss to them. Because of the great power of Hurst cyclic theory. Let's have a look. I've combined 2 cycles. What happens if we combine more than 2? Here I've combined 3. The price movement is this purplish line at the top. Do you notice the same general type of price movement? A move up, a move down, a move up, a move down. Okay, in price. Let's combine 4 cycles. No, not 4 cycles, I beg your pardon. This is a combination of 6 or 7 cycles, and there's a harmonic ratio of 3 to 1 in there as well. So it starts getting really interesting. When we combine all of these cycles, do you notice what happens with the price movement? The price movement is still a move up, a move down to the point at which the peak of the longest cycle occurs, then a move up, and then a move down. So, what am I saying? I'm saying that this is the shape of a cycle as expressed in the financial market. A cycle is, of course, still something that moves up and down like a sine wave. That is still a cycle. But what is the shape of a cycle in a financial market? It is this shape here. That is the shape of a cycle in the financial market. If you have a look at that shape, there are 4 distinguishing separate moves in that shape. There's not simply a move up and then a move down. There is, in fact, a move up, which I have imaginatively titled leg number 1 of the cycle. Then there is a move down, which is leg number 2. Then there's leg number 3, which is another move up. And then there's leg number 4, which is a move down. So if we were trading this pink cycle, most people would expect to, first of all, trade the move up to the peak and then trade the move down. But as I've just demonstrated, the pink cycle as expressed in a price movement is in fact a shape that consists of 4 moves or 4 legs, not simply 2, not simply up and then down. Okay? And so that is what sentient trading is all about. Instead of simply trading the move up on a cycle and then the move down, we want to trade one or more, or perhaps all, of these 4 legs and separate movements in the way in which that cycle expresses itself in the price movement, which is this sort of M shape. Okay, so that's the basic idea behind sentient trading methodology. All right. I started off, and you recognize the difference between different markets, and I demonstrated how the different markets have different peaks and different troughs, and then said, what is that all about? Well, it's actually all about the shapes that the cycles make in the price movement. Okay. Now, I have also presented what is the usual type of shape that you find in the market. So you might be sitting out there thinking, okay, so there is an infinite number of shapes that the cycles can take. In fact, the really good news is that there is not. There are only 16 possible shapes that you can find in any market at any degree of scale, from the sort of 10-minute cycle all the way up to the 54-year cycle, up to infinity and beyond. There are only 16 possible shapes. And that is an extraordinary thing, because once you begin to understand these 16 shapes and start trading them, it's a very, very powerful situation you're in. To make it even easier, there are only 3 types of shapes. There are bull shapes, bear shapes, and inverted shapes. Okay? Bull shapes are shapes of cycles that very simply end higher than they start. Simple as that. Bear shapes are shapes, cycle shapes that end lower than they start. Inverted shapes have a middle point that is lower. That middle point in the M shape is lower than both the start and the M and the end points. So it makes something that doesn't really look like an M anymore, and it's called an inverted shape. Inverted shapes are generally very rare, so that's the good news. Let's have a look at the bull shapes, and there are the bull shapes. There are only 5 of them. There are only 5 possible bull shapes. That's the really good news. They have been imaginatively titled Bull A, B, C, D, and E. Those are the 5 bull shapes. Let's have a quick look at them. Now, in order to be a successful sentient trader, you don't need to know the difference between a bull A, a bull B, and a bull C, and a bull D, and a bull E. Okay, but I'm showing you them here as a matter of interest. This, as you can see, has been identified by Sentient Trader as a bull A shape. Those 2 numbers in brackets refer to the short-term underlying trend, which is the underlying trend of only 2 cycles longer than your trading cycle, and the long-term underlying trend, which is the underlying trend of all cycles longer than your trading cycle. Okay, so this is a bull A shape with a short underlying trend of 1. In other words, slightly positive, and a long-term underlying trend of 2, which is slightly more positive, perhaps. Okay, here are the 4 legs of a bull A shape: leg 1, leg 2, leg 3, leg 4. Notice something about a bull A shape. Leg 3 is a very impressive leg, and it's something that you would probably want to trade. Leg 1 is pretty impressive. Leg 2 and leg 4 are both very unimpressive. Let's have a look at a bull B shape. Here you can see legs 1 and 3 are both impressive. Leg 2 is not impressive. Leg 4 is pretty much equal to leg 3. Okay, I'm not going to over sort of emphasize the differences here. It's not important that you, as a sentient trader, are able to distinguish the shapes, because Sentient Trader software does it for you, and so it's not important that you can distinguish them. So I'm going to rush through them a little bit. This is a bull C shape. Notice that the second peak after leg 3 does not come above the peak of leg 1. That's what makes it a bull C. Notice also that this looks very much like a triangle in classical technical analysis. So a triangle is in fact a bull C shape. Here is a bull D shape. Here you can notice that the second peak comes slightly above the first peak. But the end of the pattern is below the end of leg 2. That's the difference there. Here's a bull E shape, which is a pretty nasty shape, and often tends to be a shape that happens right towards the end of a move, and has some sort of bearish portent. Okay, let's take a look at the bear shapes. Bear shapes are shapes that end lower than they started, and all bear shapes have stronger wave 2 and wave 4 combinations, or leg 2 and leg 4, than they do leg 1 and leg 3. Okay, there are also 5 bear shapes. They are imaginatively called bear A, bear B, bear C, bear B, D, and bear E. And here they are. You can look at them. It's all really interesting. In fact, I could make this PDF available for you as a download, if you like, and you can browse it in your own time offline after this presentation. And so there are all the bear shapes. Now, what about inverted shapes? Well, inverted shapes are shapes that have a midpoint which is lower than both the start and the end. Inverted shapes are very rare. And in fact, in these examples that you'll find that I found for you here, you'll see that it's actually very hard to find bear shapes, inverted shapes. I beg your pardon, inverted shapes. Inverted shapes are usually an indication of there being a problem in your analysis. If you have a lot of inverted shapes, that's a sure sign that your analysis is not very good. That's a rule of thumb. It's not an absolute. It's not an absolute rule. PDF will be great. Right, I'll upload that a little later. So these inverted shapes usually are very rare, and in fact you'll see in these examples all the bear and bull shapes I presented you were on daily charts. In these examples I've had to plunder intraday charts to see where I can find the inverted shapes. and many of the inverted shapes, in fact, happen over weekends, as you can see, where Sentient Trader doesn't worry too much about the dummy data values that it has invented over the weekend, and will often assign an inverted shape over a weekend period. So here are the inverted shapes. There are 6 of them. Again, really, it's not the kind of thing where you need to sweat the details and study all the different shapes and know how, and be able to identify them. Sit there. I'm not going to have a sort of a flash quiz at the end and say what shape is that. It's not very important. I can pretty much do it, but sometimes I get them wrong. There are 6 inverted shapes: 3 inverted bulls and 3 inverted bears. And they are usually very rare. Those are the shapes of the cycles. Now, I started this whole conversation about can you differentiate between 3 different markets? Here's a forex market. Here's a commodity market, and here's a stock index. Can you differentiate, and how can you differentiate? And some of you had a go and got some right and got some wrong. Looking at a market, I can't always distinguish them, although I like to believe that I'm improving in that regard. So how do you distinguish between different markets? And here is the punchline, if you like. You can distinguish between different markets because I propose that financial markets have character. What defines that character? I've said that what defines that character is the shapes of the cycles that are found in that market. And so how do we define the character? And there are, in fact, 2 ways that you can really define the character and understand the character using Sentient Trader. The one way of understanding the character is by viewing statistics in Sentient Trader. You can look at the statistics of what shapes are present. Let's have a look. I just pulled up a chart arbitrarily and clipped a few statistics from the chart. Here are the total shape occurrences. Okay, in this particular chart, you will notice 73 bull A shapes, 130 bull B shapes, 18 bull C shapes, 127 bull D, 55 bull E, and so on and so forth. Okay, notice I mentioned that the inverted shapes are much rarer than the bull or the bear shapes, which is an indication of a good analysis. Let's add up all the inverted shapes here. That's 5 and 12 is 17, 19, 23, 24. There are a total of 24 inverted shapes altogether, and there are, looks like about 300 bull shapes and about 200 bear shapes. Okay. Now, these statistics are, if you like, a fingerprint of the market that you're trading. Okay. The statistics from one market to another differ. And if you compare the statistics between a stock index and a forex pair, you're going to find different fingerprints revealed through these statistics. Okay. Similarly, if you compare one share to another share, you get slightly different fingerprints, although generally in a similar sort of a vein. Let's have a look at some more statistics. How many bars are there per leg? Let's say that we wanted to trade the 80-day cycle. We know that in leg 1 or wave 1, there are 25 bars on average. So therefore, a leg 1, wave 1 trade would be on average 25 days long, 25 bars long. Look at how wave 2 is only 7.6 days. Wave 3 is 14.9 days, and wave 4 is 17.5 days. Again, this information is like the fingerprint of the market that you're trading. Okay? Let's have a look at some more statistics. Price move per leg. You're trading the 80-day cycle. That gives you, leg 1 gives you an 8.4% average price move. That's if you time it perfectly. Okay? Wave 2 gives you minus